Yo, what's up, everybody? It is Monday, December 9th. I went to the range today. Maybe you could see this. Let me tell you something. The recoil on the 30-06 is brutal, man. I got whacked right here with my scope on the recoil. Cut my nose pretty good. So I gotta remember to stay back because that thing's got some kick, let me tell you. So anyway, markets, let me go over what I said last week. I said that the November spike in fiscal flows, okay, that gave us a very, very powerful stock rally in November. I think it was like the biggest rally in I don't know how many years in November or something like that. And I said that now we are going to see these monthly flows revert back to the mean or the average monthly flow, which is still very, very high. I've been telling you guys, it's, you're still talking like 680 billion a month, 650, 680 billion, but we were almost at a flow rate of 780 to 800 billion a month in November, which is crazy, man. So I said that reversion to the mean, we're going to get a correction in risk assets and stocks primarily, and that's happening. It's not going to be big. It's not going to be big. It's not going to last a very long time. It might only last a few days. It might last a week. Because like I said, even the normal quote unquote flows are extremely strong. You're talking about 650, 680 billion a month. I mean, those are numbers, if you think about those numbers, like way back in the George Bush presidency days, the government was doing like, 3.5 trillion net, leading spending flows annually. Now we're doing over 7 trillion. So like we were doing like, 300 billion a month was a big month back in the George Bush days. Now we're doing almost 700 billion a month. I mean, think about it. It's massive. It is massive. But the other thing that I have been pointing out to you guys is that even with those huge leading flows, we're only seeing growth like 2.5 to 3%. And there's a reason for that. Well, there's probably more than one reason, but the main reason is that, and I've explained this in the past, is that how we have the automatic stabilizers, things like unemployment insurance, Social Security, Medicaid, Medicare, food stamps. That's like when the economy contracts, those things automatically expand. Those payments automatically grow because people, they apply for help, and the safety net that it's called, that's there. And so that acts as a stabilizer to the economy when the economy contracts. And that's how like people ask me sometimes, well, Mike, if the economy goes into a recession, how do we know when it's okay to buy stocks? And I always say, when you start to see those automatic stabilizers really start to expand, that's the safety net coming in, and that's the bottom in stocks, and that's when you really want to be buying them. And the cool thing is that, I follow this stuff every single day. Not that we're in a recession, we're not, and we're nowhere near it right now, but if it ever happens, I'll be able to tell you exactly, when that point is reached and when you want to go in like really, really aggressive, like you want to leverage up and go in. But that's for a date in the future. So what I was trying to explain is that we also have a phenomenon which is kind of like the inverse of the automatic stabilizers. And that is when the economy grows after a period of time, it starts throwing off more and more tax revenue to the federal government, right? When the tax revenue goes in, that's draining the swimming pool, okay? And the reason why that happens is because wages go up, corporate profits go up, so the nominal amount of taxes being collected by the government goes up, and it acts as kind of an automatic brake, like a car brake on the economy. So that's why we're only growing at like 2.5% to 3%, in spite of the fact that we got 7 trillion plus of leading flows. Okay? I mean, the net transfers, I was talking about this a lot last year, are shrinking year over year. You know, they were like, in 2023, they were 1.7 trillion. Last year, they were 1.4 trillion. Right now, they're running a little bit high, but that's kind of like a calendar issue because, well, it's two things. The IRS gave an extension to tax filers who were affected by the hurricanes back in October, so that's not going to hit until May 2025. And also, we just had a little bit of a calendar issue at the start of fiscal year 2024, which was October 1st, 2023. For those of you who have my report, you know what I'm talking about because I've explained it a million times. So that's the reason why 7 trillion plus leading flows, 2.5%, 3% growth in the economy is about normal, what we've seen over the last, basically like the last 30 years, with the exception of, the COVID rebound. When we got that huge increase in government spending, the COVID rebound was like a 20% growth rate off of the bottom. Unbelievable. But normally, that's what we see, like 2.5% to 3%. But now it's taken a lot more. If you look at, or if you think about these flows as energy, okay? It's taken a lot more energy. If you think about these flows like rocket thrust, it's taken a lot more thrust to lift that rocket up out of the, or to escape the Earth's gravity. Back in the past, it took 3.5 trillion to create a 2.5%, 3% growth rate during the Bush years. All right. Now it's taken 7 something trillion. So it's taken a lot more thrust. A lot more thrust is necessary just to maintain that, modest growth rate. All right. But nevertheless, stocks are still in a bullish mode. The other thing I'll mention is the Bitcoin situation, which, if you've been listening to me over the past week, I'm kind of fascinated by this whole thing because this could really be a paradigm shift if Trump goes ahead and establishes a national Bitcoin reserve. For one thing, it's going to make the Bitcoin price go through the roof. If you think it's high now, forget it. The other thing is that it has major, major implications for markets. I'm not going to get into that because that's something I'm talking about to my subscribers. Okay, I feel like that's privy information. That is insight that you're not going to get somewhere else. Nobody's talking about it, that at least not that I see right now. And that's, by the way, that pretty much applies to everything I tell you guys. The others are not talking about it, or they're talking about something completely opposite, which doesn't turn out that way. So some of you have taken advantage and signed up for a 30-day free trial. I am going to raise the price of a subscription on January 1st, 2025. Right now, it's a very, very reasonable and cheap $125 a month. But I'm going to boost that up to $195 on January 1st. So now's the time to get in. Dollar was up against the yen. It was up against euro. I think the dollar could bounce around still in here for a little while longer. But the path for the dollar is up. Okay, the path for the dollar is up. U.S. As a net exporter of petroleum, among other things, that are bullish for the dollar. But I'm just looking at this trend, this expanding reality of the U.S. being like the biggest or among the biggest net exporters of petroleum. Trump is coming in. He's gonna really come down hard on Iran and their petroleum exports, and that's going to have a dynamic effect, an important effect, I believe, on the dollar. Is going to make the U.S. petroleum export. By the way, we're here in the U.S. 13.5 million barrels a day of production, and now they're talking about opening up leases in the Arctic National Preserve. So I mean, we're the biggest oil producers in the world. The United States is the largest oil producer in the world at 13.5 million. I don't think anybody comes close. The Saudis maybe have a top line capacity of 12 million. I don't know about Russia, but right now, we're number one easily, and a lot of that is getting exported. So the dollar is going to stay strong. I mean, it is indeed right now like a petrodollar. Like we've heard this term thrown around for years and years, and I always thought it was kind of like a meaningless term, but now it does mean something. It does mean something. So, yeah, I guess that's it for today. I would look to be a buyer of stocks. Chip stocks were down today. If you get a little bit more downside in the market, I would definitely consider that as the correction that I said was going to happen. Based on reversion to the mean, things are still very, very strong. The other thing is that we saw a backup in bond yields today. Small, not a big deal. Totally expected, technically or whatever. I think this rate cut that is coming up on the 18th, the Fed rate cut, 25 basis points will bring the rate down from 4.25 to 4.5. That's it. That'll be done for a while, but I don't think it's done for good. I think that's a pause. I think that Trump wants lower rates. I think Powell wants to keep his job, and I think rates are going to come down, slowly, but they're going to continue to come down. So you want to be long treasuries. The other thing that I found very interesting and also kind of upsetting, I have to be honest with you, is that, and this is, I guess I should probably save this for its own video, but I'll get into it briefly. The commercial banks now have record holdings of Treasury securities. Now, if you remember, during the whole period from March 2022 until basically when the Fed stopped raising interest rates, banks had to liquidate an enormous amount of Treasury securities. They had to get those securities off their books because the price of those securities were going down because the Fed was raising rates. That's how it works. And because banks are forced to market the price of those securities as they dropped, that was capital erosion. And they had to get it off their books. Otherwise, they would have had to raise capital. Otherwise, if not, they could be faced with a situation of insolvency. But now they bought them all back, which shows you that it's just needless loss, inducing because of the regulatory structure that when the Fed raises interest rates, it forces the banks to have to sell. There's no risk in holding treasuries to maturity. The government's going to make good on them. okay? But forcing the banks to take losses because your regulatory, setup is so screwed up, and then only to see the banks have to buy them all back. I mean, that is so unnecessary. And again, it comes back to, I've said this so many times, like, you got the people in control who make, back in the financial crisis, 2008, 2009. Remember when John Paulson, who was Treasury Secretary at that time, he goes to Congress, he says, we need $787 billion to recapitalize the banks. Why? It was the same thing, because asset prices were collapsing, so the banks they were facing insolvency. So he goes to Congress, we need $787 billion to recap. And I was just saying at the time, just suspend mark-to-market. Those securities are good. Just suspend mark-to-market, and you don't have to go raising, asking Congress for $800 billion. They didn't do that. I mean, that would have been the simplest thing in the world. This is so needless and so ridiculously loss-inducing for no reason whatsoever. You got a bunch of dummies running this show, man. I'm telling you. But like I said in the video last week, that's stuff we can work with to make money. When there's this vast universe of stupidity out there, like I said last week, I don't need inside information when I have people who don't understand, who are making bets in the markets based on on ignorance, basically. I just go in, with a bushel basket, and I pick them off. Now, it might not happen immediately that day or that week, but it will happen. It will happen. Anyway, that's it for today. Please like and subscribe, and don't forget, now's the time. You got a few more weeks. It's going to 195. Pitbulleconomics.com. See you tomorrow. Bye.